Good afternoon, and thank you for joining us for today's Barron Funds Healthcare Update, featuring two of our healthcare-focused portfolio managers, Neal Kaufman, who runs the Barron Healthcare Fund, and Josh Riegelhaupt, who assists on the Barron Healthcare Fund and manages the Barron Small Cap Biotech Strategy. In addition to managing the Barron Healthcare Fund and Biotech Strategy, Neal and Josh are senior members of our healthcare research team. In this capacity, they work with many of the firm's portfolio managers in covering a sector which makes up a pretty significant portion of our firm's total assets. My name is Glenn Smith, and I'm the National Sales Manager of Intermediary Sales at Barron. I'll be the moderator for today's call. Before we get started, I just want to highlight some really impressive accolades and statistics which Neal and Josh have achieved while managing the Barron Healthcare Fund. Effective 12/31/22, the fund boasts a 5-star overall rating from Morningstar, ranking in the 4th percentile of its trailing 3-year time period among U.S. healthcare funds. To provide a little bit of additional context, at the end of the year, Barron Healthcare Fund has returned 12.41% annualized over the last 3 years, which outperforms its benchmark, Russell 3000 Healthcare, by more than 2.45% on an annualized basis. More impressive are some of the fund's risk and return characteristics. As of year end, the fund has added 2.32% alpha with a beta of 1.04, all while capturing 102.2% of the upside and only 92.18% of the downside over the trailing 3 years. Impressive results indeed. So with that, Neal, perhaps you can kick off with some of your thoughts on the fund's performance during the 4th quarter of last year.
Thanks, Glenn. In the December quarter, the fund rose approximately 9%, better than the 7.5% gain for the S&P 500 index, but not as much as the 11.5% gain for the Russell 3000 Healthcare Index. The relative shortfall during the quarter was due to some of our investments in biotech, healthcare equipment, and healthcare technology. In biotech, weakness in Inhibrx, which is a new position in the fund. It's a clinical stage biotech company with a pipeline of candidates using its protein engineering expertise and a proprietary single domain antibody platform. The shares declined after we started our position in mid-October, due mostly to general small cap biotech weakness into year end, and partially due to a correction after the stock had been up on some updates. In addition, moderate gains from our high conviction positions in argenx and Vertex, along with lower exposure to some of the strong performing large cap companies like Gilead, Amgen, and AbbVie, presented additional headwinds to performance in the quarter. Negative stock selection in healthcare equipment was related to OpSense, which is a fiber optic sensors manufacturer in the healthcare space, as well as intravascular lithotripsy leader Shockwave and transcatheter aortic valve replacement leader Edwards Lifesciences. In addition, one of our positions in the healthcare technology space, Schrödinger, weighed on performance in the quarter. Schrödinger shares were down after management lowered guidance due to foreign currency headwinds and slower adoption by some smaller biotech companies of its software. Some of the customers were impacted by the capital markets environment. And then there was just some uncertainty about the timing of year-end purchase decisions among some of their largest customers. These negative effects were somewhat offset by favorable stock selection in life sciences tools, pharmaceuticals, and managed healthcare, along with strength in our position in McKesson, a healthcare distributor, and lower exposure to some healthcare supplies companies. In life sciences tools, Mettler Toledo was a strong performer. Danaher was a strong performer. In pharmaceuticals, AstraZeneca was a strong performer. That was partially offset by our underexposure to Pfizer and Merck, whose shares were up significantly in the quarter. And in managed care, performance was bolstered by our position in Elevance Health, which is a large managed care company. The shares rose in response to strong quarterly results, and they raised guidance driven by solid medical cost management, strength in their PBM unit, and healthy enrollment growth. Back to you, Glenn.
Thank you, Neal. In your comments, you mentioned a company called Inhibrx, which I believe is a new name in the fund. And as a biotech company, I believe that's something Josh would cover. So Josh, can you tell us a little bit about the company and maybe what your investment thesis is?
Sure, Glenn, thanks. So yes, to address the first most important fact, I am with a heavy heart leaving Barron to go pursue my career as a mixed martial arts fighter. I've enjoyed all my time with you guys. No, but seriously, okay, so Inhibrx. So Inhibrx is a biotech company. Neal mentioned they have this single domain antibody platform. I'm going to just briefly touch on it. So if you guys know, antibodies have this kind of canonical Y structure. I actually tried to pull one up and see if I can do it. No, that's not going to work. Okay, another time I can show it to you, but anyway, this Y structure, and when you have this Y, it kind of looks like this. This is the part that binds to the bad actors, your either bacteria, virus, or whatever else, and then the part that sticks out the bottom, they call the constant region, because they are across all your antibodies. They're pretty much the same. So what's interesting about these is that they tend to have these double domains, and they have a very canonical biology. When Inhibrx created their technology, they figured out a way how to make them singles, or single domains versus double domains. And that means you can build antibodies in a different way. And that was kind of their technology, which is interesting. Like I said, Wall Street doesn't really care about this. So what does Wall Street care about? Wall Street cares about really their alpha-1 antitrypsin program. This is a recombinant or replacement protein for patients who are deficient in alpha-1. And the disorder is called alpha-1 trypsin deficiency. I've talked about this in the past with other companies. This is a rare disease, it's not so rare. So we tend to only care about the worst off patients because they have the worst outcomes and the ones who are going to get addressed from a commercial perspective first. They have something called a Z mutation. That's in contrast to an M mutation or an S mutation. There's about 100,000 of these Z patients floating around the US, and about 5 to 10% of total of those are treated. There's reasons the penetration is so low. This number I just told you is probably also still a low number in the fact that there is another lung disease called COPD. It's much more common, chronic obstructive pulmonary disease. And there is a good percentage of COPD patients who are likely actually AAT patients and who are just not diagnosed for various reasons. So what does Inhibrx offer? Right now, how do these AAT patients get treated? They get something called augmentation therapy. What that really is we filter the blood. It's called apheresis from healthy people. So any of you could go to some blood bank and give blood, and we would take AAT out of your body and give it to a patient who doesn't have it. There are 4 of these approved products on the market right now. We already know they make about 1.5 billion in sales. They've CAGR'd about 13% over the past 5 years. And generally the sentiment around this market is it's undersupplied. There's not enough donation to go around. The drugs are weekly infusions. Currently, they have risks of infections. Anytime you take blood from a person, it could be carrying something that you don't want to put into somebody else. The cost of goods, about $40,000 to $50,000 per year. And the real issue, they don't get your AAT levels up to normal. So it's like 23 micrograms per deciliter. I might have gotten those units wrong, so I apologize if I can't remember them. They get them to somewhere around like 10 to 12 on average. Every patient's a little different. And so you're sub-therapeutic. You don't get the coverage you would want to help you deal with the disease. Inhibrx, in contrast, their dosing will likely be monthly is what I'm working with now. There'll be no infection risk because it's a recombinant protein. We grow this AAT in a set of cells. And why that was hard, I won't get into, but that was part of what they cracked, was figuring out how to do that. The cost of goods will be about 20,000 or probably below. So that's in contrast to the 40 to 50 I mentioned earlier. Pricing will go down. And also, most importantly, they can get your AAT levels therapeutic range. So above the 23, and I don't want to say the units out loud again because I'll mess it up probably. So that seems pretty straightforward, like better product profile, easy enough. So what's the rub? What does Wall Street care about? Why does the stock ever go down? It has to do with the regulatory environment and what the FDA needs for approval. Keep in mind, these blood-derived products were approved somewhere in the order of 15 to 30 years ago. The current standard of care in AAT has changed. What we know about the disease has changed. There hasn't been approval since. There's debate on what is required to get past the goal line right now. What that essentially means is approval can change. Is it in 2026? Is it in 2027? Everyone cares about duration when they do valuations, particularly if you're a trader. So that's usually a good type of setup for a long-only investor, in contrast to a trader investor who would probably be playing channels more up, down, whatnot. There is another facet that is more of a geopolitical concern. A lot of the blood donations in America tend to happen with immigrants. There's a almost professional industry of Mexicans who cross the border into blood donor sites, and it's not often talked about, but it's not the nicest thing. And there's a limit to how many donations you're supposed to do in any given year, and they're blowing right through it because they want the money. Politicians kind of know about this. The FDA knows about this. If there's a better way to get around this, there's a goodwill element to solving some of these problems. And so that would be, kind of a positive sentiment act. And then I'll finally mention there's a whole oncology platform. And I mentioned these kind of single domain antibodies from the technology that nobody on Wall Street cares about. But there's going to be oncology cancer-based data readouts in ASCO. That's in June. Nobody's underwriting any value to it. And that could be like a nice inflection, much beyond what we can already underwrite with the AAT program in terms of upside. All right, Glenn.
Thanks, Josh. Definitely an interesting story, and a lot to look forward to on that name. So thank you. Neal, can you tell us about some of the other names perhaps that you've added throughout the last quarter, and any insight into those transactions I think would be very helpful for our viewers?
Sure. I'll highlight 2 of the top 5 net purchases during the quarter. So the first is HCA Healthcare, which is one of the nation's leading providers of healthcare services. They own, manage, or operate roughly 182 hospitals, approximately 2,400 ambulatory sites of care in 20 states and the UK. We think that the long-term demographic trends, as well as their strong presence in attractive growth markets where there's net population migration, position the company well to generate long-term sustainable growth. Prior to COVID, management targeted long-term top-line organic growth of 4 to 6%, with pricing and mix running in the 2 to 3% range, and adjusted patient admissions running around 2 to 3%. And COVID has been disruptive to this framework, but management thinks that organic revenue growth can return to its targeted 4 to 6% range, along with positive margin leverage possible at the high end of the range. And more recently, the company has seen contract labor costs and wage pressure start to moderate and volume trends start to improve. HCA also has a long-term track record of returning capital to shareholders through special dividends and share repurchases. The second stock that I would highlight as a top purchase during the quarter is Option Care. Option Care is the largest independent player in the $15 billion US home and alternate site infusion market. We think that Option Care is well positioned to capitalize on the ongoing shift to lower cost sites of care and the increase in new specialty drug treatments. Home infusions cost significantly less than infusions at a hospital, 40 to 70% less. And their footprint with over 150 locations allows the company to serve roughly 96% of the US population in a market that's growing 5 to 7% a year. The company has a diversified portfolio of therapies and provider relationships with no customer concentration. They have in-network status with all the large payers, and they have low direct government reimbursement risk, as Medicare currently does not cover home infusion. And we think that the market would double if Medicare were to cover home infusion in the future, which we think is a possibility. Given the company's geographic coverage and therapeutic expertise, we think that they have a seat at the table to discuss new innovative payment models with payers, and they have strong relationships with relevant drug manufacturers as well, which facilitates early access to newly approved drugs and preferred supply arrangements. And their size and scale give them purchasing power. Management thinks the company can generate high single-digit organic revenue growth and double-digit EBITDA growth. And this growth can be enhanced through M&A activity. And they have a very strong track record acquiring and integrating acquisitions. So those are two names that were new additions that we're very positive on. Back to you, Glenn.
Excellent. Thank you, Neal. So let's shift gears for a second. Josh, I believe on one of our calls last year, perhaps second quarter, you highlighted Moderna and the investment thesis around that. It looks like the fund added or increased that position over the last quarter. So I was hoping maybe you can update, our listeners and our viewers on the investment thesis, maybe talk about some of the recent clinical data and some of the things that they have in pipeline. I think they were working on a personalized cancer vaccine, something related to RSV as well. So Josh, please take it away.
Yeah, thanks, Glenn. Right, so in the past, we've talked about Moderna, and I kind of gave you a way to framework COVID recurring revenue or vaccine recurring revenue, however you want to think about it. So we're going to kind of gloss over that, but I'll give you the one-liner, which is the easiest comp is to think 500 million annual flu shots globally, and the bookmarked pricing for Moderna's vaccine or Pfizer's vaccine, whatever, once it's commercial, is in the $40 to $120 per shot. So, I mean, you can play a game with a world population over 7 billion for how many people think will get it. The most recent update as of yesterday is the FDA had a panel, the VRBAC, the Vaccines Related Biologics Advisory Committee. They want people to get annual shots. That's what they said yesterday. We'll see what happens next year, though. All right, so moving on. So what we've talked about mRNA, how it can maybe potentially change vaccination. So let's start with some of these updates. First, we'll start with RSV. RSV stands for Respiratory Syncytial Virus. It's a respiratory virus, as the R in RSV stands for. You probably read about this a little bit in the newspapers and probably were unfamiliar with it potentially before this year, but there was a lot of press on the triple-demic, and the triple-demic was flu, COVID, and RSV all coming at the same time. And this is kind of what happens when you have everyone stay at home in quarantine, no one gets sick, and then everyone comes out at the same time and everyone gets all the same diseases all at the same time. You kind of mess up the natural cycles, and then it just kind of hits you. So, Moderna as a long-term goal has always stated that one of the ways they plan to buttress their vaccine front is to combine vaccines. So you maybe get a pan-respiratory type of vaccination, that COVID, flu, RSV all in one shot. There's lots of precedent for this in terms of combo viruses or combo vaccines. If you guys have children, often those early life shots with tetanus, with diphtheria, with whatever, they package them into 4 or 5 all in one. It's a process to get there, but it obviously makes everyone's life easier. So these will likely succeed for a whole bunch of reasons and streamline the whole vaccine business. But anyways, let's get into RSV a little bit. So let's talk about the disease. It's pretty common, about 3 million global hospitalizations. In children under the age of 5, it's the leading cause of hospitalization for infants under 1 year of age, kills about 14,000 of our elderly every year. And so what I'm presenting to you is kind of this bimodal distribution. So it's really under the age of 5 and over the age of, say, 65, 70, 75, however you want to draw it. So it's very old people and young people. Many of you have probably gotten sick from RSV and just thought you had a runny nose or a cough, and you just ignored it, and then went around, spreading your RSV all over the world. But that's normal, unless, of course, you're immunocompromised as a younger person, in which case you always have your normal risks. So here are kind of your public health tidbits. Pretty much every child under the age of 2 is going to be infected. Most are asymptomatic. About 40% would end up at a doctor's office. 1% are severe enough to be hospitalized. It enters in your eyes and your nose. So you touch something and then you do this, and you give yourself RSV, or do this, whatever, like that. That's how you're not probably going to get it from breathing, because the particles are so big that they tend to drop as they come out of your mouth. You more have to kind of contact it to make it work. There's probably some respiratory transmission, but so again, this is one where you wash your hands and you're probably taking care of the problem for the most part. If you ever want to test for it for any reason, it takes about 5 days to be positive. So just give you that headline. So Moderna press released on January 17th the vaccine data, 83% or 84% effective against respiratory tract disease. That's great. That they plan to file right now, essentially first half of 23. And it looks like their vaccine is as good as competitor GSK, probably safer and better than Pfizer's competitive vaccine. So potentially they could have a best-in-class profile for an RSV vaccine. Remember, we're probably going to combine it with the other stuff eventually, but that's good. So good news, we all can go get RSV shots all the time, and hopefully not too much vaccine fatigue out there. Unclear really how often you need to get vaccinated. It could be annual, it could be every 5 years. I'll get back to you in coming time as that kind of gets figured out. Quick public health aside, I got reminded of this myself recently. I had to go get a tetanus shot. For those of you who haven't remembered to get a tetanus shot in 10 years, go get a tetanus shot. For those of you over the age of 60, 65, go get your shingles shots. And the one that people forget, pneumococcal, Prevnar. You want that. There's no reason to die from viral meningitis when you're 72 years old, when you can prevent it. And you're probably not going to be smart enough to know you have viral meningitis because your neck is stiff and your vision's getting blurred. Like, you're not going to notice it. You'll be like, I'll be fine tomorrow morning. And then you're not fine tomorrow morning and it's over. Like, you should avoid. These are easy things to prevent. Okay, so transitioning to the second item that Glenn asked, which is the personalized cancer vaccine. So this is trying to vaccinate people to either, this isn't to prevent cancer. This is more you have cancer and try to treat it, but eventually it would be both. A lot of hype around this press release. It's probably little in front of its skis is the way I would think about it. So December 13th, we got this information. They said, in the adjuvant setting of melanoma patients, what adjuvant means is we treated you, we think your disease is gone, and now we're following you afterwards. And the question is should we do nothing, or should we treat through this period where we don't know if your cancer is or isn't there, to prevent a relapse, it coming back in the future. So we know that it potentially improved on current adjuvant therapy. The real challenge with this data is that melanoma is a very treatable disease right now. And to show a separation in melanoma is going to take years. So like, we have this data, it's positive, but we won't really know how well it's working for like 3 to 5 years. So it sounds great. It's probably, and if I gave you an x-axis and a y-axis, and we do survival over time, where when patients die, the lines go down until people die, like the lines stay really high for a long time. So to show separation is really, really challenging, and they only separate over years. And so like, we won't really know how good it is for a long time. Jeffrey said it was $1 billion market. Morgan Stanley said it was a $2 billion market. Then some of them are like, it's going to work in every cancer. It's a $25 billion market. And like, it's just like, it's a classic Wall Street, like, ooh, and like, look at this. And look, it's not that it's bad, it's good. But let's just make sure we have the right lenses on to view the data. There's also just a real world commercial issue with this. We're vaccinating you. Like, we would have to draw your blood, then make the vaccine with your antigens, and there's 32 of them or 24 of them. I can't remember the number. We get it back to like the oncologist, who then does an infusion. Like, if I work in Memorial Sloan Kettering, sure, this is what I do for a living, I'm going to be able to do this. If I work in the middle of Pennsylvania at some community oncology center where I see a lot of patients all day long, I'm not the person who's going to be able to do this. And so, like, we're in this transition in the healthcare space because there's more and more medicines that are going to be like this, you know, personalized medicine for you, where the companies and all this back-end infrastructure is being built to service this and to make it like plug and play, and some random doctor doesn't have to think about the fact that they're making some like future age medicine, and they just like, you come in, they do 3 minutes of work, you come back, they do 3 more minutes of work, and it's like, that's going on all in the background, particularly because of cell therapies. But it's not exactly the standard, the state of the art today. So like, let's just keep that commercial framework in mind also. Okay, so Moderna making a lot of progress. Pretty much all their updates have been positive, so we like that, of course. Balance sheet still super strong. Still not a super consensus long on Wall Street, although I've noticed that changing a little bit over the past few months, so we'll keep an eye on that. Yeah, it's always good to have positive stuff. Back to you, Glenn.
Excellent, Josh. Thank you. This is great context, and I always appreciate the reminder on vaccinations and boosters, things that you don't think about on a regular basis on a personal front. So thank you. All that said, Neal, 2022 was a challenging year across equities in all sectors, right? We heard about a few of the positions that you guys have either added or increased over the last quarter. Maybe you can remind some of our audience what you feel sets you guys apart from other investors in the healthcare sector, and perhaps where some of these companies that you guys have talked about fit into the portfolio.
Sure. So like the other Barron funds, we look for competitively advantaged growth companies that we can own for multiple years. We think our fund is different versus other healthcare funds. We have fewer stocks, roughly 40 to 50 stocks in the portfolio, with top 10 holdings typically representing over 40% of assets. The portfolio is a growth-oriented portfolio. It's all cap. We can invest in both US and non-US companies. And in an effort to ensure diversification and to help manage potential risks, we loosely group the portfolio into 3 categories of stocks: a group that we call earnings compounders, another group we call high growth companies, and then biotech companies. The earnings compounders in our mind are companies that we think can compound earnings at double-digit rates over the long term. So for example, the 2 stocks that I discussed earlier, HCA and Option Care, they would both fit into this earnings compounder category. High growth stocks, the way we think about that, we think stocks in this group can generate mid-teens or better revenue growth. Some of them may not be profitable today, others are, but the ones that are not profitable, we think can become highly profitable in the future. An example here would be Inspire Medical, which is a medical device company we've owned for a long time. They sell a device for sleep apnea. Growing very fast, not currently profitable, but super high gross margins, and they have the ability to, at maturity, be highly profitable. And then we have the biotech bucket in the portfolio. Josh spoke about Moderna. That obviously would fall into the biotech category. And so we think the portfolio will have a mix of earnings compounders, high growth stocks, and biotech companies, and our allocations can change depending on how we see the opportunity set and the overall market environment. Back to you, Glenn.
Thank you, Neal. Certainly does differentiate the fund from many of its peers. And frankly, it makes a lot of sense from a risk and an exposure management standpoint in looking at it in terms of these buckets. So thank you for that. Do you have any final thoughts you'd like to share about the outlook for healthcare more broadly?
Sure. So I thought maybe I'd just go through our thinking on the various sub-industries within the healthcare sector. First off, after 2 very challenging years, we think that the mid-cap biotech area are much better positioned for better performance this year, in light of the fact that interest rate hikes are going to slow or stabilize, possibly even reverse. This is not a call on what interest rates are going to do. It's just looking at market expectations and the likelihood that rate hikes will slow or stabilize. So that should be a general positive for small and mid-cap biotech stocks who have been punished largely because of the fast pace of interest rate hikes. So we increased our exposure to this area. In pharmaceuticals, our largest investment continues to be in Eli Lilly. Their new diabetes drug, Mounjaro, is likely to be approved for obesity this year. They also have some new obesity drugs in development. And then they have a drug in late-stage development for Alzheimer's disease. They're not facing any significant near-term patent expirations, and we think they can generate good growth and in revenue and earnings through the end of the decade and beyond. Life sciences tool stocks were big underperformers in 2022 for a variety of reasons, including declining COVID-driven revenues, the weak capital markets funding environment for their biotech customers, economic weakness in Europe, foreign currency headwinds, COVID lockdowns in China. Some of these headwinds are now in the rearview mirror. Some of them may continue to some degree, but we think that these are good long-term investments because many of these companies have secular growth drivers, pricing power, recurring revenues, high margins, low capital intensity. So this continues to be an area where we look for new ideas and where we have a number of investments. And already in the month of January, we're starting to see many of these stocks bouncing back. In medical devices, by varying degrees, medical device companies have been impacted by nursing and staffing shortages, which has been a constraint on procedure volumes. Some of these headwinds are starting to fade to some degree. Just thinking about the long term, though, we think that many medical device companies will see increasing demand driven by an aging global population, higher disease burden from chronic diseases. So we continue to have investments in companies that we think have innovative devices for sleep apnea, diabetes, heart valve replacement, among other areas. Managed care companies had a strong year in 2022, largely due to low healthcare utilization, higher interest rates, lack of exposure to foreign currency, and they were not subject to some of the global economic headwinds that other areas of the sector have faced. This year, managed care stocks so far in January are off to a very slow start. Investors are very concerned about 2 issues where we're about to receive some clarity. One is, what are the Medicare Advantage rates for next year going to be? And then the second, perhaps bigger issue is the finalization of some rules related to audits of risk-adjusted payments to participants in the Medicare Advantage program. We think that there will be clarity soon on these 2 issues, and unless there's a real negative surprise, we think the stocks are going to recover. And over the long term, we continue to think Medicare Advantage is an attractive growth market. So overall, our long-term outlook for the sector is bullish. We think that innovation in the sector and the themes that we have been investing in are very much intact. And we think the fund has competitively advantaged growth companies with strong management teams. Back to you, Glenn.
Thank you, Neal. Definitely a lot to look forward to, and certainly a ton of innovation going on within the sector. So thank you. With that, I want to thank you and Josh very much for all of your comments. That's all that we have for today. So with that, we'll conclude today's call. Should any of our viewers have follow-up questions, please reach out to your Barron Fund sales coverage, or you can email your questions to questions@barronfunds.com. Please note a replay of today's Zoom call will be available on our website at www.barronfunds.com. I want to thank Neal and Josh for their comments, as well as all of you for listening in today. Most importantly, I want to thank you for your support of the Barron Fund family. This concludes today's call.